Okay, let's unpack this. Imagine a series of dominoes, right? Perfectly lined up, and they start falling one after another, revealing this stunning new landscape. That's pretty much what the past few weeks have felt like in the digital asset space. Especially for XRP. We've seen this wave of updated XRP ETF filings just drop, and not only in one or two hopefuls. We're talking some of the biggest names in traditional finance, and it has everyone asking, from seasoned institutional investors right down to individual crypto enthusiasts like you. What's next? What's next for XRP and really for the entire digital asset ecosystem? So today, we are embarking on a true deep dive. We're getting into these recent S1 amendments. And look, these aren't just any old regulatory documents. These are the refreshed proposals, filed by a veritable who's who of major asset managers for their proposed spot XRP exchange-traded funds. Our mission today is pretty clear. We want to meticulously pull out the most important nuggets of knowledge from all this flurry of news, right? And the intricate legal analyses, and you can almost feel the market optimism.
We want to help you understand the profound structural shifts happening right now. The newfound legal clarity around XRP, finally, after years of uncertainty, and the market's undeniably bullish reaction. This deep dive isn't just about reporting the news headlines. It's about dissecting the why. Why these filings? Why now? What about the crucial precedents set by Bitcoin and Ethereum ETF approvals? And what does this convergence of events ultimately mean for the flow of institutional capital, for overall liquidity, and for the broader journey towards mass Web3 adoption? Get ready to connect some truly fascinating dots here.
It's true. And, these aren't just dry technical filings sitting in isolation somewhere. What's particularly striking, I think, about this moment is that these amendments represent a really significant, almost like a tectonic shift in how digital assets like XRP are perceived, but more importantly, how they are being strategically integrated into the very fabric of traditional finance. So we're going to help you move beyond those headlines today, dive into the core implications, understand these complex developments. This is about seeing the much bigger picture unfold, understanding the long-term ramifications and maybe recognizing the meticulous chess game being played out by these major financial players. It's fascinating.
Absolutely. Fascinating is the word. And when we talk about these filings, look, we're not discussing a tentative little step or, a couple of firms just testing the waters. What we've actually witnessed is a veritable cascade, a flood of updated S1 amendments. We're talking heavyweights in asset management here. Grayscale, Bitwise, Franklin Templeton, CoinShares, 21 Shares, Canary, Wisdom Tree, all of them have filed updated S1s for their proposed spot XRP ETFs. This isn't some fringe movement. It's not isolated experiments. This is the financial establishment, a formidable array of players, both crypto native and traditional finance giants. And they're making a highly calculated, highly synchronized move. It feels coordinated. Yeah, think about the players involved for a second. Grayscale, right? They've been a pioneer, frankly, kind of a battering ram in the crypto asset management space. Remember their famous battle with the SEC? Years long, just to convert their Grayscale Bitcoin Trust, GBTC, into a spot ETF. So their updated filing for XRP alongside crypto-native innovators like Bitwise, and then you have traditional finance behemoths like Franklin Templeton. It signals more than just interest.
It feels like a strategic land grab. Each firm brings its own expertise, its loyal investor base, and clearly a desire to dominate what they see as this emerging institutional XRP market. It's not just a wave. It really does feel like a strategic chess game playing out in public. Everyone positioning for a slice of what they obviously believe is going to be a massive pie.
And putting this into the bigger picture, this coordinated action isn't just coincidence. I really don't think so. These aren't just random updates. They are meticulously, I'd even say strategically, designed to align with previous feedback from the SEC. They've clearly drawn crucial lessons from the often arduous, sometimes contentious Bitcoin and Ethereum ETF approval processes. This signals an exceptionally serious intent from these firms. They aren't just, crossing their fingers and hoping for approval. They are actively paving a compliant path towards it. They've adapted to the SEC's evolving demands, and this collective action, in a way, it reduces the individual firm's regulatory risk. How? By presenting this unified, informed front. It strengthens the whole argument for an XRP ETF by showing this shared understanding, this commitment to regulatory compliance. It basically says, look, we've listened to you, the regulator. We've adapted. We learned from the BTC and ETH experiences. That's a powerful demonstration, I think, of market maturity and genuine regulatory engagement.
Okay, now here's where it gets really interesting, especially for those of us, following the ETF space closely. This detail is crucial. The revisions in these S1s, they aren't just minor tweaks. They actually introduce mechanisms for either XRP or cash creation. And alongside that, options for cash or in-kind redemption. Now, for our listeners who've been following the whole crypto ETF saga, that should sound incredibly familiar, right? It mirrors the exact structures we saw eventually get the green light for Bitcoin and Ethereum ETFs.
Right. So the obvious next question is, why mirror these specific mechanisms so closely? What's the strategic advantage here? Well, it's precisely because these are the structures that finally gained regulatory approval for Bitcoin and Ethereum ETFs after, extensive back and forth with the SEC. By allowing for both XRP creation, where authorized participants, the APs, give XRP to the fund for new ETF shares, and cash creation, where APs give cash for shares, and then also allowing cash or in-kind redemption, these filings are deliberately boosting their operational credibility. In the eyes of the SEC, that is. This flexibility isn't just about operations, it's a strategic move to appease regulators. Let's just break down the implications of this dual approach for a second, because it's important. Cash creation is generally, well, let's say preferred by regulators, or at least seen as simpler. It streamlines the process for traditional financial institutions. Why? Because it avoids them directly handling or custodying volatile crypto assets. This model can, in the SEC's view, reduce concerns about market manipulation. It offers a sort of cleaner pathway for institutions wary of directly touching digital assets. It minimizes compliance headaches for many. But, there's always a but, a purely cash-settled model can sometimes be less efficient for those authorized participants when it comes to arbitrage. That can potentially lead to slight differences or deviations between the ETF's price and the underlying asset's actual spot price. The tracking might not be perfect.
Okay, so that's the cash side. What about the other option, the in-kind?
Right, the in-kind creation option. That's where APs exchange XRP directly for ETF shares. Now, this is a powerful tool for market makers. It allows for more capital-efficient arbitrage, and that directly contributes to tighter bid-ask spreads. It helps ensure the ETF tracks the spot price of XRP much more accurately. This efficiency ultimately can mean lower transaction costs for you, the investor, and a more robust, healthier market for the ETF itself. Now, while some regulators might initially be a bit more cautious about in-kind, its benefits for market efficiency and price tracking are pretty undeniable. And think about XRP specifically. Given its primary use case in cross-border payments and on-demand liquidity, the in-kind mechanism could offer really unique efficiency for APs who might already be holding XRP for operational reasons. It could let them create ETF shares with lower transaction costs, tighter spreads, compared to a purely cash-settled model that might introduce extra foreign exchange risks or conversion delays for global institutions using XRP daily. So this dual approach is trying to navigate that delicate balance, right, between regulatory caution and market efficiency. It's a tightrope walk the SEC looked at very closely with both BTC and ETH. It's a sophisticated move, designed to satisfy a wider range of market participants, satisfy regulatory preferences, and ultimately make the ETF more appealing and operationally robust.
Right, a very calculated move. And these meticulously crafted filings, it didn't just appear in a vacuum, did they? They landed right after that monumental development. The one that sent ripples, yes, pun absolutely intended, throughout the entire digital asset space. I'm talking about the dismissal of Ripple's SEC appeal. For many, including us, that's not just coincidence. It feels like a truly powerful regulatory signal, one that fundamentally changed the playing field and, frankly, opened doors that seemed firmly shut before.
Yeah, the real intrigue, as I see it, is precisely the timing and the profound impact of that legal outcome. The legal clarity that came from Ripple's partial win in its SEC case, it fundamentally, and I mean fundamentally, changed the regulatory perception of XRP. Specifically, the court's ruling determined its status as a non-security when sold programmatically on exchanges. Now, that distinction is incredibly significant. Why? Because it directly de-risked the asset for institutional products like ETFs, which primarily deal with assets traded on secondary markets. Before this ruling, the pervasive uncertainty, the cloud hanging over XRP's classification, was a major, almost insurmountable hurdle for any regulated investment vehicle. Think about it from an asset manager's perspective. Bound by strict compliance, fiduciary duties, they were understandably hesitant to touch it. The potential for massive legal liabilities was just too high.
So that court ruling really carved out a specific path.
Exactly. The critical nuance was that explicit distinction the court made. Programmatic sales typically to retail and exchanges deemed not securities. Institutional sales to sophisticated buyers deemed were securities. This created a clear legal pathway for an ETF trading XRP on secondary markets, because that aspect of XRP's activity was legally de-risked. Without that specific granular clarity, an XRP ETF would have just remained stuck in legal limbo, facing massive liability concerns for any asset manager. And it's important to emphasize, like you said, this wasn't just any lawsuit, it was a landmark case. It's had far-reaching ripple effects across the crypto industry. It provided a degree of legal precedent, some clarity that many had been seeking for a long time, not just for XRP, but potentially for other digital assets caught in similar classification limbo.
Right, a pivotal moment indeed. And before XRP even got to this advanced stage in the ETF race, we all watched that incredible journey, sometimes incredibly frustrating journey, of Bitcoin and Ethereum ETFs getting regulatory approval. And when they finally launched earlier this year, wow, they didn't just walk, they absolutely ran, resulting in historic inflows that honestly even seasoned market watchers found astonishing. They blew past a lot of the initial, more conservative estimates. It really set a precedent.
So the natural follow-up then is, what did the BTC and ETH ETF rollouts truly teach us? What's so directly applicable to XRP's situation right now? Well, firstly, they unequivocally demonstrated that investor demand, the appetite for regulated crypto exposure, is immense, far bigger than even the most optimistic initial forecasts suggested. People want in. And they want in through familiar, regulated channels. Channels that fit into their existing investment portfolios, their risk management frameworks. Secondly, these launches showed us that regulatory bodies, while yes, inherently cautious, primarily focused on investor protection, they will eventually approve products, but only products that rigorously align with their established norms and effectively address their concerns about market manipulation, custody, transparency, all of that. Just to illustrate this, think back to the scale of those historic inflows into the spot Bitcoin ETFs right after launch. We saw literally billions of dollars flow in within weeks. They quickly gathered tens of billions in assets under management. This wasn't just, a modest success. It was a blockbuster event. A concrete example of both the market's enormous appetite and, frankly, the successful navigation of incredibly complex regulatory waters.
And Ethereum followed. Maybe a bit quieter initially, but still significant.
Exactly. The more recent Ethereum ETF approvals, maybe with less immediate fanfare than Bitcoin, but they reaffirmed the SEC's evolving comfort level, their growing understanding of regulated crypto investment vehicles. This evolution in regulatory comfort, it structurally and conceptually paved a clearer path. The SEC built an understanding of the market's dynamics, the robust custody solutions that exist now, the surveillance sharing agreements designed to mitigate manipulation risks. This established blueprint is basically what assets like XRP are now trying to replicate and even build upon.
And just to hammer home the impact of that Ripple legal outcome again, it's worth circling back. That legal clarity following Ripple's case, win. It hasn't just reduced uncertainty. It seems to have actively catalyzed interest, shareholder interest, institutional interest in XRP-based investment vehicles. It truly felt like a pivotal moment, a turning point that just changed the entire game for XRP.
Yeah, the core implication here is just how directly the court's decision impacted market confidence. You could almost see it shift. When a major cloud of legal uncertainty, one that hung over XRP for years like a storm, finally lifts, it fundamentally changes the entire risk assessment for institutional investors. They now have a much clearer legal framework to operate within. They understand, or think they understand, precisely when and where XRP is considered a non-security. And that makes it a much more viable option for regulated products. To reiterate that key point, the specific aspects of the ruling. Finding XRP not a security when sold programmatically on secondary markets. That is incredibly favorable in an ETF context. This move from profound legal ambiguity to relative clarity isn't just helpful. It is absolutely crucial for asset managers. They have to operate within strict compliance guidelines, fiduciary responsibilities. They need that assurance. It gives them the confidence they need to proceed with these filings, knowing a major legal hurdle has been substantially lowered, or maybe even removed entirely in this context. Without that clarity, you can bet the legal department of any major asset manager would have likely red flagged an XRP ETF indefinitely. The court's decision essentially served as the green light they needed to move forward with some conviction.
It's perfect sense. And zooming out just a bit, let's think about the broader power of ETFs themselves. Historically, ETFs aren't just investment products, are they? They're powerful signals. Signals of mainstream asset acceptance. They widen access for everyday investors, sort of democratizing investment in asset classes that were once exclusive or just too complex. And often, they spark renewed attention.
attention in tokens that might have been previously overlooked or maybe just misunderstood because of complexity or that regulatory murkiness we talked about. It's a legitimization mechanism.
Absolutely. And putting this into the broader picture, the eventual approval of an XRP ETF, if it happens, would be far more than just a win for XRP itself. It signifies a further deeper maturation of the entire digital asset class. It provides that familiar, regulated on-ramp for traditional finance to access crypto, something they've desperately needed to sort of bridge the old world with the new. This leads to greater legitimacy for the whole asset class. It fosters broader understanding among a wider investor base, and ultimately deeper market integration into the global financial system. Think about it. When an asset like XRP gets wrapped in an ETF, it moves from being purely a speculative digital token, often traded on, let's face it, less regulated exchanges, to becoming a truly investable asset, available on traditional brokerage platforms. That perception shift is critical. It validates the underlying technology, the utility, for a vast swath of investors who might never, ever touch a crypto exchange directly. And that can catalyze a virtuous cycle of adoption and acceptance. This isn't just about market access. It's really about altering the fundamental narrative surrounding digital assets.
Okay, let's shift focus slightly to the data and the market reaction, because numbers often tell a story. So with all these positive signals, the institutional stampede, the mirroring of successful ETF structures, that crucial legal clarity, how did the market react? When these amendments dropped, well, XRP price jumped approximately 7% almost immediately after the announcements came out, and trading volumes surged noticeably across major exchanges. That's a pretty clear indicator of optimism when it speaks volumes without a word.
Yeah, a key takeaway from that immediate reaction is the swiftness, right, and the magnitude. A 7% jump in a relatively short period. That isn't just market noise. It's highly indicative of renewed investor sentiment, and it seems directly tied to these ETF prospects. It suggests that a significant chunk of the market views these amendments as a strong, tangible step towards ultimate approval. This immediate surge often reflects what we call the buy the rumor phenomenon in financial markets, where investors position themselves before a favorable future event they expect. This initial rally indicates a strong belief that these filings are indeed bringing an XRP ETF closer to reality. So you see preemptive positioning, both retail and maybe some institutional investors trying to front-run the potential inflow of billions that could happen once an ETF goes live. This isn't just wild speculation. It feels like a calculated move by smart money reacting to clear regulatory signals.
Right, buying the rumor. And it's not just current investors making moves based on optimism. We're seeing forecasts, projections from major players that hint at truly massive inflows if an XRP ETF gets approved. JP Morgan, for instance, a titan in global finance. They estimate around $8 billion in ETFs capital in year one alone. I mean, just let that sink in for a moment. $8 billion. That's not pocket change. That's serious institutional firepower, potentially aimed at XRP.
It's a huge number. So the natural follow-up is, where does a forecast like that even come from? And what does it imply for the market? JP Morgan's $8 billion estimate for year one. It's a powerful signal, isn't it? It signals the pent-up institutional demand that could be unleashed once an XRP ETF is live and accessible. This isn't just retail enthusiasm or wishful thinking. It's a projection of substantial capital allocation from sophisticated traditional investment vehicles, pension funds, endowments, sovereign wealth funds, wealth managers. These entities have largely been on the sidelines, right? Waiting for a regulated, accessible product that meets their stringent compliance and fiduciary requirements.
How do they even arrive at a number like $8 billion? What goes into that calculation?
Well, forecasts like these are usually built on several layers of analysis. It's not just pulling a number out of thin air. Firstly, they look at the total addressable market. How much institutional wealth is currently sidelined due to regulatory constraints or just the lack of suitable investment vehicles for crypto? Secondly, they do comparative analysis. They look at the initial inflows for Bitcoin and Ethereum ETFs. Then they scale that, considering XRP's current market cap, its existing investor base, maybe its unique global utility proposition. Thirdly, they might factor in potential new entrants, particularly from markets with a maybe higher affinity for XRP, like parts of Asia or the Middle East, where RippleNet has seen significant traction. Now, while JP Morgan's $8 billion is a prominent figure, it's worth noting forecasts often have a range, right? Some more conservative analysts might project closer to, say, $3 to $5 billion. They might factor in initial cautious allocations, a wait-and-see approach from some institutions, conversely others. Looking at XRP's global utility, its potential to capture a slice of the cross-border payments market, they might see potential beyond $10 billion, especially as Web3 adoption accelerates and more global institutions look for efficient settlement layers.
So $8 billion is significant, but potentially just one point in a range of possibilities.
Exactly. And just to put that $8 billion into context again, compare it to the initial inflows for BTC and ETH ETFs. While those were significant, an $8 billion projection for XRP in its first year, that demonstrates incredible belief in the asset's potential, both from its existing, often passionate community and from this expected new wave of institutional investors seeking diversified digital asset exposure, this influx of capital.
Yeah.
It wouldn't just impact XRP's liquidity, right, leading to deeper order books, potentially less volatility. It would also play a crucial role in its price discovery, and it could substantially increase its overall market cap, really solidifying its position in the broader crypto ecosystem. It would truly be a transformational event for the asset.
Okay, transformational indeed. Now, to really grasp the sophistication here, why these amendments are being called a very good sign? It helps to look at them side by side, maybe. How do these newly amended XRP ETF structures actually compare to the BTC and ETH ones, especially when it comes to those critical creation and redemption flows we discussed? Because, like you said, those specifics aren't just technical jargon. They really matter for regulatory approval and for how efficiently the market works.
Yeah, placing this in broader context again, this comparison is absolutely crucial. It helps understand the strategic intent behind these latest filings. Both Bitcoin and Ethereum ETFs, after all that dialogue and refinement, eventually settled on that cash creation model, often with additional options for cash or in-kind redemption for their APs. The fact that the proposed XRP ETFs are meticulously adopting similar structures, XRP and cash creation and cash or in-kind redemption, it demonstrates a clear commitment. A commitment to mirroring the regulatory comfort and operational best practices that were painstakingly established by their successful predecessors. This isn't coincidence, it's definitely calculated compliance.
So walk us through the pros and cons again, but specifically in the context of XRP, cash creation first.
Right. Cash creation, as we discussed, generally seen as simpler by regulators, avoids direct handling of the volatile underlying asset by traditional firms, reduces manipulation concerns, maybe custody complexities. It also makes it easier for a wider range of institutional investors who just don't have the infrastructure or maybe the regulatory green light to hold spot crypto directly. The downside. It can be less efficient for APs doing arbitrage. They have to manage both cash and XRP positions separately, potentially adding friction or cost.
And the in-kind method for XRP.
In-kind creation. APs swapping XRP directly for ETF shares offers superior capital efficiency for market makers. This method usually leads to tighter tracking of the ETF's price against the spot XRP price. That benefits all investors, minimizes those annoying premiums or discounts. And for XRP specifically, designed for rapid cross-border value transfer. The in-kind mechanism could offer unique advantages. Think about financial institutions already using XRP for on-demand liquidity. It might be far more efficient for them to create ETF shares directly with their XRP holdings rather than converting to cash first, which might involve extra FX steps and costs. This could lead to better liquidity, tighter spreads for the XRP ETF compared to a purely cash-settled model. So by offering both, the XRP ETF proposals are maximizing flexibility, they've got the cash option for regulatory ease and broad access, and they keep the in-kind option for market efficiency and potentially lower costs for certain players. It's a sophisticated dual approach, trying to satisfy everyone, market participants, regulators enhancing the ETF's appeal, its operational robustness, and ultimately its market impact.
Okay, it sounds incredibly well thought out, building on past lessons. So with all these intricate pieces falling into place, all these strategic moves by major financial players, what does this mean for the timeline? Can we get a sense of when a decision might come? We can sort of plot key events like milestones on a roadmap, right? We had the Ripple lawsuit dismissal, crucial legal clarity. Then this flurry of significant amendment filings. And if history, especially that recent history of Bitcoin and Ethereum ETFs, is any kind of guide, we have a projected SEC decision timeline. According to various analyses, market whispers, it seems likely to be around October.
Yeah, the real intrigue, I think, is having that potential target date, even if it's just an estimation for now, the likely October projection floating around. It gives investors, market participants, a specific window to focus on. It definitely creates a palpable sense of anticipation. But more importantly, maybe, it provides a clear point for the next potential major market catalyst. This lets market observers actively monitor developments, anticipate how the market might react as that date gets closer, potentially leading to increased trading activity, maybe more volatility in the run-up. This is where you see the market trying to price in the probability of approval.
But it's not guaranteed for October, right? There could be delays.
Oh, absolutely. It's crucial to talk about potential reasons for delays. We need a balanced perspective here. While October is tagged as likely, the SEC is known for its cautious, deliberate approach, especially with novel asset classes like crypto. We could easily see further questions from the SEC staff, requiring additional amendments from the filers, which would extend the review period, unforeseen market volatility. maybe from broader economic factors, or even just other pressing regulatory priorities piling up on the SEC's desk, that could lead to extensions or postponements. Plus, the SEC might want to observe the performance and market dynamics of their recently approved Ethereum ETFs for a bit longer before they jump into another major altcoin like XRP. It's never a done deal until it's actually a done deal. The regulatory landscape for crypto is still complex, still evolving. But having this timeline allows you, the listener, to follow developments with informed expectations. Feel well equipped to understand any news approval, delay, more questions, whatever emerges.
Okay, so watch this space, especially around October, but be prepared for potential shifts. Now let's bring this right back to why it matters, Section 4. Why it matters for you, crypto investors and Web3. Beyond the immediate market moves, the excitement, the institutional jockeying, these ETFs, if approved, would fundamentally legitimize XRP. Legitimize it as a regulated investment option. That feels like a profound game changer for so many potential investors. Just shifting how they can even think about allocating to the asset. It's like a stamp of approval from the highest financial authorities.
Exactly. So the natural follow-up is, what does legitimized as a regulated investment truly mean? In practical terms, for the broader market, it means potentially opening the floodgates to a vast pool of institutional capital that has, until now, largely been sitting on the sidelines regarding XRP. We're talking colossal entities here. Pension funds managing retirement savings for millions, sovereign wealth funds allocating national reserves, traditional asset managers overseeing trillions for clients, maybe even corporate treasuries looking for diversified asset exposure. These entities are often legally or operationally restricted from investing directly in unregulated digital assets. It's due to their mandates, their strict risk management policies, the complex regulatory frameworks they operate under, an ETF wrapper. It provides that necessary compliance framework, the investor protection structure that these large players absolutely require. It offers a familiar, audited, transparent structure, making XRP accessible through standard brokerage accounts, traditional investment platforms they already use daily. This dramatically expands the universe of potential investors. It integrates XRP into the mainstream financial system in a way that direct purchases on crypto exchanges simply cannot. It signals that XRP, at least through this wrapper, has met the stringent requirements of traditional finance.
And it's not just optics, right? Not just opening doors. There are real, tangible economic benefits, too. We're talking about unlocking potentially massive institutional capital. And that directly translates into improving liquidity for XRP, which is a benefit that helps everyone involved in the market, not just the big players.
Yeah, placing this in broader context again, increased institutional participation generally leads to a significantly healthier market. More robust, more mature for XRP. What does that mean? Deeper order books, more buyers and sellers at various price points, which naturally tends to reduce price volatility, makes the swings less wild. When there's more liquidity, it's significantly easier to buy or sell large quantities of XRP without dramatically moving the price against you. This stability, this ease of transaction, it in turn attracts even more participants, both institutional and retail, creating a positive feedback loop. Think of it like a thriving, bustling global marketplace versus a small, quiet village stall. In the bustling market, lots of transactions happen smoothly. Prices are more stable. Buyers and sellers easily find each other. At the small stall, one large transaction can totally skew the price. So more liquidity makes the market function more efficiently, more predictably. It benefits all market participants, smoother entries and exits, potentially tighter bid-ask spreads, a market more resilient against big price shocks, and for an asset like XRP, designed for global payments. This improved liquidity isn't just a nice to have. It's arguably fundamental to its long-term utility and adoption.
Makes sense. A virtuous cycle driven by institutional confidence and access. And the ripple effects, sorry, I can't resist the pun, they extend even further, don't they? Beyond just XRP itself, the legitimization, the increased capital flowing into XRP. Could that, in turn, fuel broader Web3 adoption, create a kind of halo effect for the whole ecosystem?
What's particularly striking there is the potential for that significant halo effect. I think that's a real possibility. As one prominent digital asset like XRP gains mainstream acceptance, gets institutional backing through a regulated ETF, it inevitably builds confidence in the broader Web3 ecosystem. It sends a powerful, unambiguous message to traditional finance. Hey, innovation and regulation can coexist productively in the digital asset space. This encourages further exploration, further investment into other Web3 technologies and projects. Institutions might then feel more comfortable researching, allocating capital to other assets, other protocols that demonstrate similar maturity or utility or maybe regulatory clarity. So yeah, this isn't just about XRP. It's potentially about setting a precedent for the entire space, demonstrating a pathway for other carefully vetted digital assets to achieve similar integration, and that could significantly accelerate the flow of talent, research development into the Web3 space. More capital creates more opportunities for builders, innovators, entrepreneurs, ultimately pushing the entire industry forward.
A rising tide lifts all boats, perhaps. Okay, so after this pretty deep dive, what does this all mean for you, our discerning listener? We'd genuinely love to hear your thoughts. Engage with your insights on a few key things here. First, do you think these amendments, especially coming after that Ripple legal clarity, make an XRP ETF basically inevitable? Or, is it still too early to hype? Are there still significant hurdles in your view? Second, if an XRP ETF does get approved, what price level would you personally be aiming to see baked in as a result? Are you thinking $5, $10, maybe even beyond for XRP? What's your personal projection for that market impact? Third, would you personally allocate to XRP via an ETF wrapper? Or would you prefer to get exposure another way, maybe holding the asset directly on a crypto exchange? Pros and cons to both, right? We're curious about your strategy. And finally, thinking about those mechanics we unpacked. Which specific structure tweaked the creation flexibility with both XRP and cash? Or the redemption flexibility, which one do you think matters most for an ETF's ultimate success and why? Share your informed perspectives in the comments. We really do read them.
Yeah, these are profoundly important questions because they challenge all of us collectively to think critically about market sentiment, about the far-reaching impact of regulatory decisions, and about our own personal investment strategies. There are certainly multiple valid perspectives on each of these points, and your insights are always invaluable as we all try to understand and navigate this rapidly evolving landscape together. The beauty of this space, I think, is that shared journey of discovery.
Couldn't agree more. Okay, let's try and bring it all together now, tie a bow on this deep dive. We've seen this strategic coordinated lineup of major asset managers, Grayscale, Bitwise, Franklin Templeton, and others, filing updated S1 amendments for spot XRP ETFs. These applications are meticulously mirroring the structures that ultimately led to the historic success of Bitcoin and Ethereum ETFs. Lesson learned, it seems. This strategic move is hugely bolstered by the legal clarity from Ripple's SEC case dismissal, which fundamentally de-risked XRP for these kinds of institutional products. And this, in turn, has already fueled significant market optimism. We saw the price jump. And some truly substantial institutional capital forecasts are out there. JP Morgan projecting maybe $8 billion in year one alone. The likely October decision timeline means this story is definitely far from over. We'll be watching every development closely, eager to see how these dominoes continue to fall. Now, if this deep dive helps shine a light on why these XRP ETF filings matter so much and maybe equipped you with some crucial insights, then hopefully we've done our job today.
And hey, don't forget, your engagement really does help support our channel. Liking this video, sharing your thoughtful comments and questions below, seriously, we want to hear them, subscribing if you haven't already, and hitting that notification bell. All of that directly boosts our visibility in the algorithm. It lets us keep creating this quality crypto content, helping you stay ahead of the curve and making sure we can continue these deep dives that hopefully you value. We genuinely love hearing your thoughts, so please share them below.
And just placing this in the broadest context one last time, beyond the immediate impact on XRP and its market, a successful XRP ETF approval could potentially redefine the regulatory playbook for other digital assets currently navigating their own legal and classification uncertainties. So this raises a really important final question to ponder. Could it set new, clearer precedents for what the SEC considers an ingestible digital asset within a regulated fund wrapper? Could it shape the future of crypto integration into traditional finance for years, maybe even decades to come? It's a question that could determine the fate of many other aspiring digital assets waiting in the wings. Something to think about.